Basically, what I will try to do today is to propose, with a provocative title, the idea the finance is not the dark side of the force. Basically, the force with a small letter, but I wanted to put the capital letter like in Star Wars, like to say, basically in a strongest way, with a different language, but the same idea, somehow Alessandro Vercelli put forward in this in the presentation of Hyman Minsky thought. And so the fact that there are two ways in order to interpret the role of finance in the economy. The traditional orthodox view implies that finance is just a servant of the real economy, and so financial disturbances are not a regularity of the dynamic process of an economy. And so to speak, finance is an interpretation like the dark side of the force, with just a black spot that comes once in a while. Otherwise, there is another view, which is the one which Hyman Minsky belongs to, in which finance is just the structural part of the economy. And so there is an eternal interaction between the two levels of the dynamic process of an economy. So if we want to understand the behavior of a capitalistic economy, we have to perceive the capitalistic economy as the interaction of two forces, real side and financial side. These forces are intertwined. They are structurally unstable because they are intrinsically incoherent, and so the forces driving the dynamics of real economy are not necessarily coherent with the forces driving the financial side of the economy, and so endogenously the two forces may bring the system from expansion to recession and so on. There's nothing not natural in the fact that we observe cycles, as there is nothing of not natural in the fact that we have day and light. And so there is a process, a dynamic process, in which we alternate day and light, and so inside night there is the seed of the day, and inside day there is the seed of night. Nothing not natural. Obviously, and this is what I want to do in this presentation, is that we have to somehow to give the flavor of what has happened in the last 2 decades, and then to show something at empirical level and something at that's not too, I don't want to use a too difficult word. It's something at methodological level. So something which is useful in order to build an interpretation of endogenous financial instability. So we start observing that the financial crisis that we have experienced in the last decade, or financial crisis that we have observed in the last 2 decades, have become more frequent, deeper, and contagious. And all these facts are at odds with the mainstream view. So we need, obviously, different instruments in order to explain why they are more frequent, why they are deeper, and why they are contagious. So let me start with some explanation. With respect to the role of the financial markets inside of the economy, let's start. I will try to be very simple. First of all, if we go through the literature, even the scientific literature on the role of finance, we may find a number of papers in which we have a negative myth regarding the role of financial markets. Basically, you may have papers in which you find that financial markets are no more than casinos, and so it's better not to have them. So it's better to have these financial markets as smallest as we can. But this negative myth has to be contrasted with a fact. The first fact that we can oppose with respect to this myth is that the fact that financial markets basically are just places where the operators indulge in or entertain into speculative activities. And so the main point over here is to understand what do we perceive with the word speculation. What is speculation? And then we have to go back to Keynes in order to explain this activity. Speculation is not like the activity that usually we have in mainstream economics, which is where speculation is synonymous of arbitrage. So usually in mainstream economics, if we use the word speculation, this means just arbitrage. I exploit the difference in prices in different markets which may be different for different places or different point in time, and I exploit this difference in order to make a bid. And I will try to profit in such a way that my own behavior will produce a stabilizing effect, because by the act of buying and selling activities, the shifts in demand and supply in different markets will create an increase in demand where prices are too low, and increase in supply where prices are too high, and so we will have a movement in the prices which is stabilizing. But speculation is not arbitrage. Speculation means that operators, they try to guess what is going to happen in different markets. And this guess is based upon the fact that the agent believes that he will be better than others in doing the prediction. And so he will be able, in the end, to have a profit on his own activity. So it may be the case, the difference between speculation and arbitrage is the fact that if the speculator knows that, for example, a price is moving far from the fundamental level. So if the speculator believes that, for example, an activity is overvalued with respect to the fundamentals, but if the speculator believes that other buyers and sellers are going to buy in the future, they are not going to sell the activity as an arbitrage or behavior would imply, but he will go to buy, and so diverting the equilibrium price from equilibrium. So the fact that the speculation activity is fundamental in order to understand that the speculative activity is intrinsically destabilizing. Okay? Then the positive myth behind financial market. This one is the so-called capital market, financial capital market efficiency, FAMA, whatever Merton, all the standard view of finance. Financial markets are efficient. This is obviously a result and not a property of financial markets. So the idea that financial markets are efficient is based upon some kind of hypotheses which are obviously violated by real world. And especially the fact that we observe in real world is that the increasing financial complexity that we observe in globalized financial markets is such that even more than in the past, the financial stability is a result which is far more difficult to attain than in the past. So these are basic ingredients that we have to take into account in order to understand what's going on in the financial markets. If we want to summarize the main causes of recent financial crisis, we may say that we can somehow say that there are different ingredients in these causes. One has to do with the fact that somehow there is a macroeconomic justification that we can radicate into risk appetite, obviously too high. And so another one relates, an element of preferences, of individual preferences. Another one has to do with the instruments that were used in order to make a decision in the financial market, which is a wrong evaluation of risk. Another one, and basically it is a combination of the last two issues, is that I started this presentation saying that the real and the financial side can lead possibly to a stable dynamic path if they are dynamically coherent. But as long as the real side or the financial side move at different pace, then we have the source of instability. So if we have an instability coming from the financial side, so if the cause of instability is a financial cause, then obviously is that because the pace of the financial side is incoherent, for example, too strong with respect to the evolution of the real side. And so we have the connection of two elements, that at global level we have an increasingly globalized economy in which a possibly likely real convergence of different paths of the economies is combined with financial divergence. So basically the financial structure of different countries around the world has not developed in an equal way, and this has caused financial fragility in emergent countries. If we take together all these things, we have somehow the precondition of a structural characterization of the fact that the financial instability is not something that happened randomly, but is something that builds inside the very nature of the dynamic process of now global dynamic growth of income and wealth of nations. So we have some lesson from the past. Oops! So I think that something has changed the structure of the software. So the lesson from the past are that before a financial crisis, usually we have that especially in emergent countries, we have foreign capital inflows without adequate financial reforms or gain in productivity. And so we have this first divergence between the speed of the financial will, which give a potential, and the speed of the real will, which is not able to face and to give opportunities capable to use this potential given by the financial side. Then the result is that usually the financial crises are preceded by credit expansion, and credit expansion again are too much with respect to the needs of the economy. Usually, or not only in emerging economies, we have even mature economies in which we need structural reforms. But in times of expansion, usually the authorities tend to put forward the weight of the need of the structural reform. They say, let someone else to do these things. But unfortunately, as long as we put in another period, we put forward this need for structural change, it happens that as long as the economy fluctuates between expansion and recession, it happens that obviously it is more likely that we will have to face the structural reforms when we have no resources in order to face them. And so we have to face structural reforms when we cannot do that. And so these are then other things. When the crisis sets in, so when a financial crisis comes in, we understand, obviously in a financial perspective, that the real sensitivity of the economy to the crisis is not a feature of the real side of the economy, but the sensitivity of income and real variables to the crisis is related to the level of financial fragility of the economy. So the higher the financial fragility of the economy at the beginning, the higher the real impact of the financial crisis if the financial crisis sets in. Then the other lesson that we have is that the difficulty of financial institution to be able to evaluate risk is a function of the complexity of the system. And so if the standard finance instruments are good in times where the economy is tranquil, but when the economy becomes more complex, then the method of standard finance in order to have risk evaluation, they become basically useless. And so the more we insist to use standard methods of risk evaluation under crisis, the more the mistakes and the higher the negative effects and the contagion effects of financial crisis. Then we have understood that also liquidity, which is considered basically a property of the functioning of economic system, is not a certain variable at all. It is an extremely uncertain variable, and especially it can dissolve in a moment when a crisis sets in. And finally, contagion. Contagion is the way in which a financial crisis can develop around the world. But contagion is a qualitative phenomenon. The contagion does not hit all the countries in the same way. It is in a bigger way, in a worse way, the weaker economy. So the weaker is the economy, the stronger the effects of the financial crisis. So, not a very nice view of the world. Now I'm going to present some empirical facts that I've taken from a contribution which was published in 2008 by Reinhardt and Rogoff, which is published before the other more famous contribution. I want to use this presentation for two reasons. One, in order to underline the impact of ideas given by the same people. So the same people published two papers, this one and the other one, which is the justification of austerity. We don't know basically anything about this contribution that I'm going to show you, but we know very well the other one on austerity, and the authors of the paper were exactly the same. So it is not the people who makes the difference, but the ideas inside of the paper that usually can be taken or not taken accordingly to whether they are somehow considered useful in order to sustain one view or another. And I take this contribution from 2008 in order also to underline that somehow after 2008 everybody has become sort of, we can say, Minskyan. But okay. Not this is a sort of a very popular kind of reasoning, but not all economists are Minskians from the very origin, and so I want to point out this issue, not because I haven't read anything after 2008. So first this source. I want to, in this paper, Reinhardt and Rogoff were trying to show that financial crises are not something which does not happen, but they are basically a feature of a natural feature of the dynamics of systems. So they collected a very long historical very long time series in which they observed more than 100 countries which had in the world from the beginning of the last 2 centuries ago and until the beginning of this millennium, and they show that if we measure crisis according to different kind of typical crisis, we may see that the financial crisis is not a black swan, unless you are in Australia. So the black swan is quite popular, because if you see this picture shows the percentage of countries that during the period 1800-2006 had a foreign default, a crisis due to the fact that there was a default of public debt, just foreign debt. So not any kind of financial crisis, just one very particular kind of financial crisis. So let's just to say, tomorrow Italy declares default with respect to the foreign bonds abroad, on the abroad, on foreign savers, and say this is something that we cannot do. Okay, look at the share of the countries. So it is a fairly big shares, not 1%, not 2%. But the numbers are quite big. The other standard feature is that it is said that in this picture we show the bank crisis, which is another type of financial crisis, and we compare bank crisis with the other issue, which is fairly standard in the orthodox view, which is the issue of capital mobility. According to the standard view, the proposition is that if we have the likelihood of a bank crisis is related to the fact that there's no perfect capital mobility from abroad, and so the higher the capital mobility, the degree of capital mobility, the lower the risk of a bank crisis or any other financial crisis. So the authors compare the degree of capital mobility, the capital mobility according to the same period with the occurrence of bank crisis, and you can see from just from comparison that what has happened is exactly the opposite that what is the prediction of the standard view. The higher capital mobility, the higher the banking, the occurrence of banking crisis. And then again, the length of default episodes. So the authors they say the more sophisticated the financial markets become, as long as we have an increase in the efficiency of financial market, then we are supposed to have less financial instability. And again, over here we divide. The author divides the sample into periods, or 1800 towards 1945, and then 1946 to 2006. And we can see that over a period of more than 150 years, we had 127 episodes of financial instabilities around the world, and the length was 6 years. And what do we expect after the Bretton Woods? So the year is not just by chance. Obviously, after the appearance of regulatory authorities, do we have had better or more stable financial environment? And the answer is not, because it is true, the average length of the financial crisis has shortened, but in less than, basically in 50 years, we had 3 times the number of financial episodes, financial crises than we had in the past. And so, these things obviously, so we may show this argument in different views in order to underline always the same idea that financial crises are not black swans. So they are fairly regular, and they become more and more recurrent in the environment. So basically, we need a theory which is coherent with this empirical evidence. Standard theory is not coherent, and so the alternative, and obviously, basically, the presentation given by Alessandro, pointing on the contribution of Minsky, is coherent with the description of what happens in these. So these empirical facts are completely coherent with the Minskian view. Okay, on the opposite. So From this picture is not easy to understand, but I just want to use in order to point out an idea. The authors make an exercise saying that they study 5 types of financial crisis. We may have a crisis because of default on debt, foreign debt, internal debt. We may have a financial crisis driven by the fact that we have a bank crisis. We may have a financial crisis due to the exchange rate problem, or we may have the crisis, and then we may have also a financial crisis which is due to high inflation in the country. So let's say we have 5 different types of financial crisis. The point is that from the theoretical point of view, each of the type of crisis has its own instrument to be fixed somehow. But unfortunately, from the economic policy, the economic policy authority point of view, the task to stabilize the economy is difficult, because usually when a financial crisis sets in, is not just a one type of financial crisis. So whenever we have a financial crisis, the financial crisis is not just a bank crisis, or is not just a currency crisis. Unfortunately, usually is at least 2 things. And this is a bad news for the economic policy authority, because the solution, the instruments that we need to handle the crisis, if, for example, we want to fix a crisis due to inflation, we need instruments which are in contrast, opposite to the one that we have to use, for example, in order to fix a currency crisis. But if the two are together, what kind of policy are we supposed to use? If we move in one direction, we may solve one side, but we do make the other side worse. And so this is in order to contribute to the fact that when we say, often we listen to the argument that the economic policy authority, they do not behave sound, they make mistakes, or they do not have the will to do things in order to fix crisis. But the point is that reality is complex, and mostly when a financial crisis sets in, has different kind of symptoms, and so we have to be able to understand which one is the best way in order to get out from this point. Then Minsky, as other authors that we will see later, had a vision. And so obviously, if we want to build a vision of a particular kind of vision, in which we want to explain financial instability as a rational endogenous phenomena, then we need to understand, to be able to select what kind of ingredient are the components of this vision, macroeconomic vision. And so, according to the interpretation of financial instability, I selected the ones that to me are relevant in order to explain where does a idea of a financial instability come from. First of all, obviously, we have to decide the genesis of the instability, and so we have to endogenous, exogenous, yes, somehow, to decide whether we accept a vision in which the instability comes because of an exogenous shock, or whether the instability is an endogenous property of the system dynamics. Obviously, Minsky has this endogenous view. Then we have to give a foundation of individual behavior. And the foundation of individual behavior is supposed to be rational or irrational. In the standard view, if according to the idea of the black swan, basically they come from basically irrational behavior, sort of. In the view given by Minsky, the behavior is rational, but not rational in the sense of maximizing behavior. Rational according to a particular kind of rationality, which is bounded rationality, as it is coherent with a human being facing a complex environment. Then I say that we, according to the functioning of the financial markets, we need to attribute a role to speculation, and so to decide whether speculation is stabilizing or destabilizing. And obviously the element is that the speculation is destabilizing. Then over here we have a thing that in some sense Alessandro somehow just pointed out in a word. We need to decide what kind of technical representation we use, so what kind of analytical tool we will prefer in order to represent this system. We will choose a random word or a complex word. So we will use the tools of stochastic word or function, which are sort of deterministic but very complex. Then we have to choose whether the instability is just a sporadic phenomena or it's a cyclical behavior, and we need to choose whether the impact of the crisis is temporary and localized or widespread and persistent. This last thing obviously leads to the policy implication of the model that we are going to develop. So basically, a view like the one developed by Minsky is this choice. Obviously, we can build thousands of different macroeconomic theories, selecting differently the elements. So we may have theories of stability, instability, financial, real stability, mixing in a different way, the ingredients of this vision. What I'm just simply saying is that if you want to understand, have a deep understanding of what the contribution of Minsky is that we need to set our mind taking these elements, and not trying to interpret Minsky according to elements which are not these ones. So we need to wear these kind of glasses, otherwise we are not able to take fully an understanding of Minsky contribution, which is not only Minsky contribution anyway. Then, so basically these ingredients lead to are the basic in order to have a theory of instability which is rational and endogenous. But we have to make a further step. The further step is that behind an idea of rational endogenous instability, we need to have together the interaction of three elements. First, we have already said, the first one is that we have to recognize that the interaction of the real and the financial side of the economy is simultaneous. Basically, if we want to use the standard language, money and finance are not neutral in the economy. The economy cannot dichotomize. So this is just to say in another way to make the statement. Then the other point is that there is a potential conflict between the micro dimension of the decision and behavior and the macro instances. So what the individual wants maybe is in contrast to the well-being of the economy as a whole. We can call it in another technical way. It may be the word of rational endogenous instability is a word which exhibits fallacy of composition. So macro cannot be understood only using microeconomics. Macroeconomics is something more than micro, than the sum of micro. And finally, and this is important too, if we need to have instability as a structural feature of the economy, we also need an interaction between the structure of the economy, the so-called fundamentals, and the automatic adjustment of the market. So this is another way to state that somehow, in order to have this kind of instability, some players, fundamental players of the economy, and obviously one of the fundamental players is the institution, political economy, but more in general, other institutions that interact with markets in order to set the rules, they have to make, on purpose or not, mistakes. So without mistakes or without the market not giving the correct interpretation of the action of the other players in a mistaken way, again, we cannot have this. So these three parts are essential to the understanding of an idea of rational endogenous instability. Few words on each of the steps. So this is just in order not to let you believe that I say you have to believe that these are three things, and so I try to show a little bit more this point. The interaction between financial and real side of the economy can be easily seen through an asset liability statement. I use this one because this is at the core of the Minskyan interpretation of the representation of the working of the economic system. The economic system is perceived as a network, complex network of balance sheet relationships. And so an asset liability statement, which is one of the parts of a balance sheet, is obviously a way in which we can see the interaction between the real and financial side of the economy. Obviously, if you have any understanding, hopefully any understanding of a balance sheet, in a balance sheet you have on one side assets, which is, let's call the real part of the economy, and on the other side the liability statement, which is the sources or the financial side of the economy. The financial side is divided between debt and internal funds. Obviously, if during your own activity, you may be a firm, you have an activity, an economic activity during the year, at the end of the year you end up with a revenue, a profit, and then internal funds can increase, and so obviously your assets, because the balance sheet had to balance at the end of the year, your assets are going to increase. And so in this way we see that real side of the economy determine the financial side. So the standard interpretation of the interaction between the real and the financial side of the economy is that real determines the financial side. But also we may have the opposite direction. If I am able to obtain external funds, and so if I'm able to get into debt, and I use this debt in order to increase my assets, but the increase in my assets will end up to give me more income, and then again a cycle in which I can increase assets. And so whenever we read a balance sheet, it's obvious that real and financial side cannot be divided, and we cannot understand it's absolutely meaningless to say that one is above the other, because they stay together in order to make a firm or any economic unit to survive through time. Then macroeconomic level in an economic system, the network of balance sheet relationship is important in order to understand the fact that, as you see, the asset side of one unit is the liability side of another one. So the connection is that any asset side has a counterpart in the liability side of another, and so the connection comes from something, a relationship which are opposite from one unit to another. So in a sense, something which is good, which is good for one unit is bad for the same thing as good and bad, according to the fact that for one person may be credit and for another one is debt. So let's start with the process of contagion. One firm becomes sick. And unfortunately, what happens is that if it is sick, sooner or later the other ones, the connected one, will become sick too. So the liquidity problem of one unit will lead to the depletion of the funds from people who were rich somehow. So someone was indebted, but someone has become poorer because in his own asset has something which is not going to be paid anymore. And so, contagion. This the problem may start as a liquidity problem, then it becomes a solvency problem, and then it may end up with failure. And so, at the end of a process of contagion, we may end up with the disappearance of firms. So this is the meaning of the representation of an economic system in which we understand the nature of interacting balance sheet networks. So obviously we need stable and efficient financial market. Is not that we are good or because we want to try to contain somehow this possible effect of contagion and of disappearance of economic activity from the economic system because of the interaction that we have between financial units. And so this is the first piece of the analysis, the role and interaction between finance and real side of the economy. Then second step, the second ingredient I was saying is the possible issue of fallacy of composition. And this fallacy of composition is due to the fact that from the macroeconomic point of view, we have four statements which can be applied to the financial market. Savers are rational, like any other individual, but especially savers are rational. Financial markets are competitive. Market rewards innovative ability. And if you create a linkage between the productivity of one player and his own remuneration, this has an incentive effect. Well, unfortunately, if you use these arguments that are standard in order to create wealth and well-being on the real side, if you apply these things to the financial side of the economy, you end up with a very fragile economy, starting from a very rational behavior. And so, if we want, so this is an example. So I'm short of time, but I think that you understand very well the issue behind these four statements. Basically, this application of standard macroeconomic principles that we use normally on the real side of the economy, we apply on the other side of the economy, which is the financial side of the economy, and we end up with financial innovation. Derivatives. Derivatives are a financial innovation. And the ones who are able to use financial innovation are rewarded with profits. Yeah, but then we ended up with the derivatives that were not at the basis of the subprime crisis contagion mechanism. And so, fallacy of composition. And why do the system fail? The methodological starting point is that in a complex world, any individual has limited information. The limit of information relates to different kinds of limits of information. One is uncertainty, the other is asymmetric information. This leads to the fact that under limited information, uncertainty and asymmetric information produce bounded rationality for the individuals, and so the result of this bounded rationality is that prices usually do not perform their own role, and so basically prices are not efficient, or put it in another way, prices are not enough, do not contain enough information to be enough for being the only relevant variable for a decision by the individual. Okay, I do not have time in order to say that prices do not perform the work. And over here, the role of fundamentals. I was starting this example saying that we need also the role of the economic policy authority. We have examples of what so-called economic policy mistakes. Obviously, I've taken a position. So in the economic policy mistake, I put at the end of the parenthesis the European Union austerity policies. To me, so I take a position. So I will never publish any more contribution, but it's a mistake. And so, in some sense, the crisis, the Great Depression, is been understood as an economic policy mistake. Obviously, not all the interpretation of the Great Depression relate to this view, but there is at least a view in which the Great Depression, the Friedman interpretation is that this was a mistake because of the contraction of the monetary policy, and then Asia, the crisis at the end of 1997, and Brazil. But then we have also mistaken anticipation of correct policy. So the policy was correct, but we had financial instability due to the not correct perception of these policies. I cannot dig into this historical things. I just add this presentation saying that theoretical reflection on instability and the role of finance is not only related to Minsky, but have a number of authors. So I put obviously in the end Minsky, starting from the contribution of 1964, but the idea that instability from somehow financial nature can be a natural feature of the working of the economic system comes from different authors. Over here, just to mention, Smith in the Wealth of Nations is not the third edition of the Wealth of Nations. The attention here in Smith was how the interest rate and the usury law can be harmful for the well-being of the system. So it's not instability, but how finance can adversely affect the behavior of the economy through interest, the interest rate. So first, an idea of how finance can affect the economy negatively is in Smith. Then Veblen, Luxemburg, all three, use the idea of instability relating to not a very complex economy. And so this connects with the idea that somehow Alessandro Bercelli was pointing out in the lecture, saying that there are stages in the development of a capitalistic economy. And so over here the role is related to the role of money. So the financial side has a basically negative effect in the dynamics of the system because of the destabilizing force of money. And then Fisher, Keynes, and then all the other finally introduce the element of finance. So credit becomes the issue of the core of the financial instability. So basically, if we want to understand authors like Minsky, we have to go back in the past, back at the early 30s of the last century, because there, with the work of Fisher, we have the introduction of finance as the stabilizing force of the economy. So it's always so it's something related to finance. First interest, then money, then credit, and so finance in the modern way. And obviously the other authors like Bright, Kaleski, and Steindl somehow can be reconnected to the Keynesian interpretation, and so they are evolution of the Keynesian interpretation. And more recent, Galbraith, Schiller, and Kindleberger, they do not relate exactly to the same ingredients. So they related to international relationship instead of the rationality of behaviors and so on. And so Galbraith, Schiller, and Kindleberger are not somehow coherent in the interpretation with Minsky. So if we want to understand Minsky, you have to connect especially to Fisher, Keynes, Kaleski, and over here I didn't put another author, which is extremely relevant to the understanding of Minsky, but which is not exactly related to this framework I presented of ingredients, which is Schumpeter. So Schumpeter is relevant to for being able to having an understanding of Minsky, but the ingredients of the vision that I gave you is not coherent with Schumpeter anyway. If you want to have an interpretation of the importance of financial instability or of the role of finance in the economy, you cannot miss Schumpeter. So I hope that here I give you a framework, a methodological framework, in order to be able to put together the authors and to have a path in order to understand the issues related to economic policy and to the problems and to the things that you have to put together in order to build your own interpretation of the macroeconomic dynamics. Okay. Thank you.